Welcome back to The Explainer. Today, we're jumping into a huge alert for anyone with a stake in silver. You see, something massive is shifting under the surface, and it could totally upend everything you think you know about the metal's real value. Okay, let's get right into it. It all kicked off with this number right here, 31%. In a single day, silver took its worst hit since 1980. But listen, if you think that means the silver bull run is over, you are absolutely missing the real story. In fact, a number like this, it isn't the story, it's the cover story. You know, what we just saw wasn't some normal market dip. Not at all. What the analysis suggests is that this was a declaration of war, a full-on, deliberate attack by the paper silver market, that's all the digital contracts, against the physical silver market, which is, the actual real metal you can hold. So how in the world does something like that even happen? Well, there's a lot of evidence pointing to this crash being anything but random. It looks like it was engineered, following a very specific playbook. So let's break down how it was done. The timeline here is pretty revealing. First, you've got big banks with these massive bets that silver's price is going to fall. They're called short positions. But the price just kept going up. So then, boom. On January 7th, the CME exchange, the guys who make the rules, suddenly jacked up the margin requirements by a whopping 47%. That basically acted as a kill switch, forcing a ton of traders to sell, which started this domino effect of liquidations, all while a convenient news story gave them the perfect cover. So you have to ask, why would they pull such a drastic move? Well, it all comes down to this one kind of terrifying number, 350 to 1. That is the reported ratio of paper claims on silver to the actual physical silver that exists. Let's really dig into what that means. It means exactly what it says. For every single ounce of real silver sitting in a vault, there are 350 different digital IOUs claiming ownership of that same ounce. It's a house of cards. I mean, it's like a bank selling the same gold bar to 350 different people. The whole thing only works as long as nobody actually shows up and asks for their metal. If they did, the entire system would just implode. And this is the direct result of that broken system. We're seeing what's being called the great decoupling. The price of paper silver and the price of real physical silver, they're not walking hand in hand anymore. They're splitting apart into two totally separate markets, two different realities. And here's what that two-tier market looks like in the real world. Over in the West, on the New York COMEX, the paper price got hammered. But in the East, in places like Shanghai, where they trade the actual metal, premiums are sky high. Why? Because an export ban has trapped the physical supply there. It just perfectly illustrates the huge difference between an unlimited supply of digital promises and a very limited supply of a real asset. Okay, so this is where it gets really personal for a lot of regular investors. If you're holding the big, popular SLV silver ETF, you might be walking right into what our source is calling the paper trap. Look, the most important thing to get about SLV is that it's a derivative. You don't actually own silver. What you own is a share in an unallocated trust. And get this, it's managed by the very same banks that have been fined billions for manipulating metals prices. They literally have an interest in keeping the paper price low. And that creates this massive risk called cash settlement. Buried deep in the fine print is a rule that says if there's a crisis or a supply squeeze, they don't have to give you the silver. No, instead, they can just pay you out in cash at the low manipulated paper price. So let's just spell it out. With SLV, 1, you don't own the metal. 2, it's run by the very people who benefit from a lower price. And 3, the big one, in a crunch, they can just hand you cash at the fake paper price, even while real physical silver might be selling for double that on the open market. You get the manipulated price, not the real-world price. So what's the move here? If the paper market is a trap, how do you actually get out of it? Well, the analysis lays out a pretty clear 3-step escape plan to go from holding paper promises to owning the real thing. And these 3 alternatives are reportedly where the smart money is starting to flow. The key thing they all have in common is they're tied directly to physical silver, not those paper contracts on the COMEX. All right, option 1 is PSLV, the Sprott Physical Silver Trust. Now, unlike SLV, this fund holds specific, allocated bars of silver. Each share is tied to actual metal sitting in the Royal Canadian Mint. The crucial difference here, it's redeemable, and it's completely outside the COMEX system, which is why you'll often see it trading at a premium. It represents real metal. Option 2 is the most straightforward. Physical bullion. We're talking about buying actual coins or bars and holding them yourself. This is the ultimate hedge against any kind of paper market chaos. You know, the old saying is true, if you don't hold it, you don't own. And your third option is silver miners. Think about it. These companies are literally digging real metal out of the earth and selling it to buyers who need the physical product. That means their income is tied to the physical price people are actually paying, not the paper price you see on your screen.
So the bottom line is this. That 31% crash wasn't a sign that silver is weak. It was a calculated move. It was basically a gift to the banks, letting them escape their bad bets. The real warning here is don't let them trick you into giving up your real position for one of their paper promises.
And that really brings us to the one final question that this whole analysis leaves you with. As this giant crack between the paper and the physical worlds gets wider and wider, you just have to ask yourself, when that paper market finally does break, what are you going to be holding? A promise or the real thing?